introducing you to our next speaker, Nabil Kabbani. He is the CEO of NeoFi. I hope I pronounced that right. And he's going to be talking to you about how to win after you capital raise. So I'll let him introduce himself because he probably does a better job than I do. So Nabil, thank you for joining us today.
Thank you for having me, Jay and Javi. And honestly, you've pronounced it correctly the first time around, which really rarely happens. Much appreciate being here. Thank you for every attendee to join. I've been in fintech for a couple of decades. I'm going to age myself. I started with Western Union when they were conquering the world. We installed about 50 countries in a couple of years, personally traveling to all sorts of exotic locations. And then I worked in big corporate. I was part of Western Union when it went public. And then I've been fascinated by startups and the valuations that they were getting. And so I really got into SaaS, fintech type startups and technology startups. And that allowed me to see the world really from two perspectives. What does it look like when you're small and growing? And what does it look like how it should look like actually on your destination point? And it gave me really good perspective of how to aim correctly and be able to say, okay, well, if this company is to look like this in 5-10 years, how do we actually build the building blocks the right way so we don't paint ourselves into a corner? I had the privilege of doing 3 different capital raises from Series A to PE. I've dealt with, we prospected about 200 plus investors over my time trying to find the right investors for the right company. I reported to 3 different boards. I'm on 2 different boards right now. I'm advised advanced startups. I'm also an Inc. CEO advisor, which is a CEO peer group, an advisory group that we help each other grow, and we have various types of companies, again, from startup to mature companies. And I currently co-founded NeoFi. NeoFi is a bank as a service neobank. So pretty much every brand in the world, be it a fintech brand, a consumer brand, or just an affinity group of people, can become a digital bank by using our product. We do everything from a bank license all the way to the technology and the customization of the apps that look white label and branded by the company's name. We're in launch mode. We're launching our first customer actually next week, which is exciting times. Second customer is coming online in a couple of months, and we're going to start to grow from there. Towards the end of the year, we're going to launch our own branded neobank. And the idea is to build it into a super app where you can have financial literacy, all sorts of banking products, payment, loans, insurtech, crypto, and wealth management, but wealth management with a smart twist where you can replicate portfolios. So what we're going to cover today is a little bit of, hopefully I can share something useful from my experience doing this, but a little bit of how to prepare for a capital raise. We're going to talk about how to manage expectations during the negotiations, what I call my 6 golden rules, how to scale once you get the money, because that's where it becomes important. Expectation setting and scaling is where you can succeed or have a problem with your investors. How to execute with excellence on your scale growth, and some shortcuts and tips on execution success. And then we'll talk about communication and dealing with board, because for a lot of us, this is going to be pretty new, especially if you're a first-time founder. So I'll be very happy to answer questions if we have time. If not, you can find me on LinkedIn. I'm sure the company will share emails and contacts. I'm very happy to answer questions after the fact and potentially help any of you if they have more pointed questions about anything I will say or anything around their business. So let's talk about the first topic, which is how to prepare for a capital raise. So it's, first of all, I should say, go as far as you can before you raise money, partly to get a better valuation, but also to validate your business model. If anybody's been looking at Twitter in the last 2 days, there's a spectacular crash and burn of a company called Fast, which I think tried to apply money and scale before they fully validated their product market fit and their growth plans, which is very dangerous. So you have to get to that stage in order to use the money effectively, in order to get good terms on your term sheet. So, try friendly money first. You could do safe notes, family, cousins, prior investors, anybody who trusts you enough to give you kind of a long room to work and make mistakes and test and build your go-to-market and your product, and then go into institutional form money. Don't think that crowdsourcing. Another source potentially that could be helpful is funding from clients. So we've had this experience. Our company was floated for about a year of burn from a client who made a large prepayment for 3 years of services. And that allowed us to pretty much fund ourselves for about a year to deploy them and to validate the business model. Call it prepaid fee or a strategic partner that want later to turn for an investor, or just have paying you enough upfront that it can carry you going forward. Also, another word of caution: don't accumulate a lot of debt that has to be paid off when you raise money. Investors want money to go to the balance sheet. So for growth, you don't want to raise 5 million and 2 million was an accumulated debt that's coming due, and all of a sudden it walks out the door and you're left with 3 million to build. It will, investors will not like that. It may close the door for you for many investors, and it will depress your valuation. So that's first point, is go as far as you can before you actually raise institutional and formal money. Second, have an MVP and a few customers lined up or on board, because if you start too soon, again, you're not going to get a new valuation, but you really won't know where to apply the money to scale. You're still finding your way in the dark, and it'll be a little too soon, and it can be very tempting to start spending money when you have it on the wrong things. The further you are, the better. Thirdly, be at a point where you've been able to identify and confirm what your point of constraint is. And we'll talk about this more, what we call unkinking the hose when you're scaling. And this is true for startup. It's true even for mature companies. You really have to understand where you are stuck in your growth and whether applying money to that point of constraint is going to solve your problem. If it does, great, go and raise. If it doesn't, then the solution is not in raising money. The solution lies somewhere else, and it's really going to depend on the questions you are asking and where you think you are stuck. An example of good scaling use of money is, for example, manufacturing or a sales team or marketing, right? But only if you have a recipe that works. If you don't have a recipe, for example, for sales that work, your qualification process isn't honed in, your target market isn't honed in, and so on and so forth, you're going to waste a lot of money fueling a process that is not going to give you the results. And that usually ends up in a disaster. You'll burn cash, you'll burn goodwill, and you won't be able to scale. Now, if you've figured out that recipe, now is the time to put the pedal to the metal and push, and that's when you go outside and get money. The fourth point is to get your ducks in a row. So simplify diligence for yourself and for investors. Hire an accountant. You can get fractional accountants, you can get accounting firms to do this. Clean your books and clean your cap table, most importantly, so that there's clarity for investors coming in on what they're getting into. Your numbers are credible. Your cap table is understandable and simple enough for people to wrap their head around. If you have very complex situations in there, try to simplify them prior to introducing your investors to your cap table. You don't want them to inherit the baggage that you may have created through some complicated deals that were written down to raise your early money. It'll make your first contact with the investor during diligence a lot better. It will show responsibility on your end and good governance, which ultimately gives them faith in you growing as a co-founder and CEO of your business. You can even hire fractional CFOs. They're around, and they are a great way to prepare you to deal with investor and give you some high-level directions. Some even have offices with junior accountants that will help you organize your books. You don't have to go crazy. QuickBooks is enough as long as you have your numbers right, especially on revenue, churn, customer acquisition cost, and your key KPIs. Then you're covered. If your subscription to magazines isn't exactly right, nobody's going to care. But if your SaaS subscription is being entered incorrectly as your magazine subscription, and you have variabilities of plus or minus 200% in monthly numbers, that will scare investors. So make sure that's correctly accounted for and it matches your system of record. So whatever you're saying are your numbers, pretty much parallel what your accounting system is saying. These are fundamentals to investors to start believing and trusting your numbers. I was at a company that restated numbers every 3 months. and they stated MRR, and then they recalculated MRR, and they had to go backwards and restate those numbers because they weren't accurate the first time they did them. It was terrible for trust building. The investors felt that they were standing on shifting sands, and they couldn't trust what was the right number of revenue per month, which made conversations and planning pretty much impossible. And frankly, they didn't know if they were taken for a ride or if it was just incompetence or issues with the system. So terrible place to be. Get your ducks in a row. Also, have your team lined up, or at least know which positions you need and the timing of your hires. So your use of funds has to be very clear when you present to investors, because that will show that you know what you're doing, you've honed the recipe, and you be able to deploy the funds quickly and effectively. What's going to happen is once you start, especially increasing expenses, your burn increases and time start working against you. So the more planning and clarity you have about your use of funds and how fast you can deploy them and where, the easier you make your job and your clarity to investors work better. So, think of, in terms of importance of team members, product first, development, sales augmentation, in that order, because CEO is always the first salesperson and should be bringing some of the early deals. And once you have the recipe honed, you can start scaling your sales. But you have to have your product, your product market fit, and your target market identified and organized correctly. 6, write a kick-ass deck. There's plenty of good examples out there. Zoho used to be touted as the mother of all decks, but find a style that matches your style and you're comfortable presenting. There's nothing worse than coming across as inauthentic, because you're forcing yourself to make a presentation that is not your natural style. So be authentic is important. They get to know the real you. Don't make too much of a show. Demos are very powerful. Make sure you cover your raison d'etre, why you should exist, what your TAM looks like, who's the competition, key features of your products, and why the product should win. If you have your thesis correctly, it adds a lot of credibility to what you're trying to do, and then it explains to investors where your point of constraint are and why money is going to be the solution to scaling. Again, going back to that same theme. Standardize your deck and your approach, because you're going to be speaking to a lot of people. And if you are going through an iteration of a different presentation every time, 100% of your time will be spent presenting on investor, and you will neglect your company. So make that process as automatic and as simple and as repeatable as you can, because trust me, you will be repeating it a lot. We, at some point, reached out to investors with a standard teaser. Then we had to do about 80 presentations. And then we got into serious conversations with about 20 of them to ultimately end up with 4 finalists. But imagine the repetition. And if you have to customize every step of the presentation, you'll drive yourself crazy. The better your deck is, the less you will have to change it as you get feedback from investors. I would say raise money like you would run a sales campaign. So identify the right VC profile. What's their industry preference, check size preference, TAM target. This is important because I've spoken to a lot of investors that dinged our company. We had fantastic unit economics, but they wanted a unicorn. And the TAM was not a multi-billion-dollar company, but it would have been a $200-300 million company revenue with great unit economics. It wasn't for those investors. So, kind of pre-select, have your qualification criteria, the same you would do with a customer. So you set yourself up for a sales process. Do they want majority or minority control? Can they do follow-on investment? What their exit preferences look like? What their standard terms look like? Run a contact campaign. Leverage LinkedIn and conferences, and set up and manage your pipeline. Use Excel or a CRM. It doesn't matter how you use it, but use it like a sales campaign. Once you're getting advanced with some potential VCs, vet them. Ask to talk to two or three founders that they backed. Ask challenging questions about them. Ask about how they reacted when founders made a mistake, how they reacted when a company was starting to go sideways. Try to understand how they will react when things go wrong, because it will go wrong, and how they back their founders and how they help their founders scale. See also what a VC can bring to the table beyond a check. The best VCs will bring you expertise. They'll bring you connections. They may have people on their team that can help you with certain areas of your business. And those are by far preferable to getting the best deal you can. And lastly, don't underestimate personal affinity with the people you're going to be working with. First, there are some good technical reasons behind it. You have the same vision, if you see the world the same way, and if you intuitively agree on the fundamentals, the work style, communication style, and are compatible with the people you're going to work with, it just makes your life with that VC much easier. This is a 5 to 7 year marriage, and it has to work well, and you have to work with people that you like working with. Otherwise, it makes things very complicated. So you hit your first obstacle or wall. And that is an important part of trying to identify how the VC will treat you and will work with you. And it helps a lot if you have, I'm not going to call them a friend, but somebody you have an affinity with and you like working with when you're doing this. So these are kind of my high-level recommendation on how to prepare for a capital raise and work kind of identifying the right investors. Let's talk a little bit about managing expectations and your negotiation. I have kind of 6 golden rules I go by. 1, be transparent with your investors, because whatever you're hiding, they will find out sooner or later, and usually at the worst time. Because as soon as something goes wrong, you'll have to explain it, they'll have to dig, and they'll find out the details. And once trust is broken, it's very difficult to go back and repair it. It will take months and months of trying to prove yourself again when trust is broken. So be transparent. They'll know what they're getting into. You'll know what their expectations are, and you'll be able to preempt and sort out those issues ahead of time. If your product is broken in a place, that's okay. I found out investors are very forgiving if you're honest. You can tell them my product will scale up to 1,000 customers, and after that I have to rewrite it, and that's perfectly acceptable, and they will back you, or at least you'll find the right investor that can back you for that. So 1, be transparent. 2, it's okay if you're not certain about things, especially about the future, because the only thing we know about the future is it's unknown. So you can present, for example, various scenarios of growth or various scenarios of how your product development is going to go, or at least identify where the variability and the risk can come from. Sets you up for success in the future. For example, you can say things like, we are confident we can hit 2 million MRR by 20XX under these conditions. But if these conditions change materially, this is how we can be impacted, whether in development speed or sales or revenue target. If our feature releases, for example, are delayed by X time, this is what can happen to us. And it shows that you're thoughtful, you're credible, and more importantly, as a founder and CEO, you're able to identify and manage risk. And again, managing the expectation is going to be key to a successful relationship with your VCs. Thirdly, play on greed. Greed is good, as we remember Gordon Gekko. VCs are in to get results. So it's okay to project an optimistic picture. You have to be your own best cheerleader. Internally, always have a middle of the road scenario and have several scenarios so that you can figure out, if your expectations don't materialize, how you will manage in the case of a middle of the road or downside scenario. But be the passionate leader for your company. Hesitation there is not very good. You can talk about different outcomes depending on underlying conditions, but be the person who is always believing in the rosier picture and the success of your own company. Don't be arrogant. So, be cheerful and optimistic. Don't be arrogant. Be respectful, but a subject matter expert. Be flexible, listen, learn. Don't get driven around by your investors. You know your business better than a VC, but they know scaling and they know management probably better. So keep an open mind, stand firm where you need to stand firm on the fundamentals of your business, but always act respectfully because they can actually be help if you keep an open mind. Golden rule 5 is a lot of founders drive hard for the highest valuation they can get. And it's short-sighted. It's great to get the best valuation you can. But one of my favorite sayings is, your valuation, my terms. Of course, you ask for what's fair and then some if you can, but pay close attention to the terms, because the terms kept influencing your outcome more than what your valuation multiple was. Liquidation preferences, shareholder rights, the framework for future fundraisers, rights of first refusal, etc. Also, make sure your visions are aligned. You need an investor that can work with you throughout your journey. So if somebody gives you a bit of a lower valuation, but you feel that they are the ones who are going to be solidly behind you when you hit the hard times, then these are the people you want, because ultimately your outcome will be better. And last but not least, golden rule number 6 is do your own introspection, figure out which terms are negotiable for you and which ones are not. So for example, you may care more about board seats than drag along rights. So once you are clear on those goals, you can negotiate better. But again, this is not just let's focus on getting the best valuation possible. And remember, especially if it's your first round, it won't matter as much because it's the future rounds that are going to matter. But it's important to get the terms that are going to help you operate and grow. So now we've raised the money, we find the ideal match in a VC partner. How do we scale and where do we spend the money? So, scale by definition is your multiplier process. You figured out how to gain customers, but you need more and faster. And hopefully this is done correctly. And now you can be doing it through sales, marketing, additional features, more partnership, et cetera, et cetera. So let's go back to what's important here. Where is your point of constraint? If you've done your work correctly up front, you know exactly where and how much. So where to apply the money and how much money to apply. And you deploy that quickly and effectively. And then you work on your next point of constraint. Because at some point, it may be sales and marketing, and then it may be fulfillment. And so it's a constantly changing cycle, and you have to be on top of it and identify if you're getting constrained somewhere else or not. Again, we call it unkinking the hose. Where is the water flow going to stop? You iterate until your next growth plateau, and then you quickly identify why you're getting stalled, and then figuring out all over again. Ideally, you're at a point where you've identified your target market, you identify your go-to-market, your product market fit is working, and all you need to do is apply sales and marketing. Then this is great. Your product, even if imperfect, can carry you for a bit. So go for a land grab. Show your investors that you can get customers, you can get revenue. And frankly, the faster you build revenue, the less dependent you are on outside funding, and hopefully you can get to break even soon, and then have a lot of flexibility as a founder on whether to get more money or just keep growing from there. So build the war chest, and then keep an eye on product and get your customer feedback. And after you do your initial land grab, start then building the features that are going to help you get more sales, but always with an eye on getting more sales. Don't build features that you don't know are going to sell. A lot of people have a vision. If the initial vision bites, that's great. But be aware of what's around you, because your next vision or the following vision may not be what your current customers require. So keep surveying, keep dialogue with your team and your customers to understand that, and keep changing the point of constraint. I think there's a question from Mr. Diaz here. For long-term cooperation with investors, what project they are still cooperating? Well, most investors typically tend to stay in a project. They picked it for a reason, and they will stay for 5 to 7 years, right? And so usually some of them will actually roll into the next. They may take some money off the table, especially their initial investment. Sometimes they will make their returns and pay back their investors, or at least their fund, and stay with you, or do another tranche from a new fund into your continued growth, and they will help you get your next level of investor. So for example, a VC that doesn't write checks of more than 5 million will help you at first, and then when you need another 20, it will help you get the other 20, and they may stay in for some of that money or all of that money. And that's where, again, your diligence about initial with your choice of VC is going to be important. So I hope that answered the question, if I understood it correctly. So I was talking about the scaling, and ideally it's sales and marketing, right? That process is very important. Depending on your personas and your hire the best salesperson you can get, automate your sales feature, make sure you're clear on who's the customer, what the persona of the people you're wanting to talk to looks like, hone your sales process, get the tools, the Sales Loft and HubSpot are great because you can automate your outreach. But there's tons of tools out there. Some of them are cheaper. Just hone that thing perfectly before you start applying money, and make sure it works. Because we've had that in one of the other companies where we thought we had it right and we ran it and we basically build a inside sales team, which are the people that do the initial contact and pass it on to your more professional closers. And that was a mistake. We actually did not need that pre-sale process, and we spent money on about 10 people team that we churned because they weren't getting result. They were getting frustrated. We were getting frustrated because they weren't being successful. And that was actually the wrong process. Our solution was a little too technical for us to have, call it a pre-sales team selling this. So know your process correctly and do this in a way that is going to be replicable and scalable. Another question from Anna here. I'd like to know, how does a capital raise take in general? So in my experience, it's taken about 6 months on average. It's very difficult to do under 3 months. Some will take up to 7, 8 months. It depends on how well prepared you are with your company. If you have your books in order, if you have your presentations in order, if you can articulate your points very well, you have a good sales deck for investors, then things can go a lot faster. And especially if you've identified the right VCs that are a good fit for the point of time where you are, your needs, and your type of product. If that process is not well honed, it can take up to 8 months. So that's a very good question, because as a founder, you need to plan to have enough fuel to run this whole period without external funding, and also be able to be distracted, because this is a significant investment. I mean, you can, depending on how large your team is, but as a founder, you can probably spend 30 to 50% of your time just dealing with the investor pipeline. So we were talking about scaling again, ideally sales and marketing. So if it's not sales and marketing and you're behind the market, so that's one of your litmus tests, right? If your product has a good market fit and you don't need to build features, then great, just sell the heck out of it. If you are a little behind competitors and you still need to build features, this is fine. And you can pour resources into product and IT and develop your features. More money will go to your build. And that's okay, as long as you're intentional and you have prepared your investors. So one of the things you want to do in your presentation, for example, is to have a good use of fund schedule. Say we're going to get 5 million, $1 million is going to go towards this, $1 million is going to go towards product development and IT, $2 million is going to go towards sales and marketing, $1 million is going to go for administration and salaries, and so on and so forth. But be clear about it. Again, aligning expectations. Fifth golden rule is avoid the temptation of team inflation or hiring many people, especially hiring too many bosses. You're at the stage where you need people that do the work. You don't need people who direct. You, at that point, should be the only director of the team until you're about 25, 30 people, where you can have a second layer of people managing people for you. So get only what or who you need. Administration functions like HR and accounting, again, last. Outsource those to the extent you can. You can use corporate organization that do all the work for you, and they'll bring you all the benefits to your employees, run your payroll, and so on. A lot of the things can be rented and borrowed to get there. So as long as you have some decent governance, you're okay. Just hire the people where you're going to be able to scale and build. And again, using Fast as an example, I was actually reading about it this morning. They got about 100 million. They hired 500 employees very quickly. And of course, their burn rate increased dramatically. So now the higher your burn rate is, the more time is working against you. And I think that's one of the reasons where they weren't getting the results compared to the money they put in that the investors or even themselves expected. And that's a trap you don't want to get into. So be very selective and only put the money where you know it's going to work and scale. It's okay to do testing. Be honest and upfront about it with investors. You can do A/B. You can say, I'm going to try this market vertical, and if it can't sell, I'll try the other market vertical. I'll try 2 at the same time. But that's okay as long as you've set the right expectation and you have to manage that expectation correctly. 6, the last golden rule, and that's a very important one for us founders, is often the founder is the biggest obstacle to scale. You've built your company to the stage where it's at, but then you start sticking to what worked for you in the first phase without realizing it's time for new ways of managing. So very important to keep learning and evolving your company. In my CEO peer group, I have a fantastic guy called Tomas, who basically because he has this natural humility, comes to every meeting and says, what don't I know? How do I make sure I'm the right CEO for my company at the current stage? His company has grown tremendously. They're north of 150 million in revenue, coming from nothing. And he just has this curiosity and humbleness to walk around and say, how do I evolve myself as my business is evolving to make sure I'm still the right CEO as things grow? And that will help you also with your investors, because they will see somebody who can grow with the company. So these were our 6 golden rules for scaling. Let's be a little more specific on a couple of execution points on how to execute with excellence, right? I mean, in general, you have to be maniacally focused on the pillar for success. Do not get distracted by anything peripherals. Work quickly. Once you start spending money and hiring people, your cash burn increases. So every month where you don't do something is now costing you X amount of dollars. Let's say your burn is $100,000 a month. That's the cost of inactivity. That's the cost of not being fast. Everything gets delayed once you just threw $100,000 out the window. So time becomes your biggest enemy until you are cash flow positive. So as soon as you figure that something's worked correctly, push the pedal to the metal as fast as you can. You basically have to operate like your hair is on fire all the time. Don't get complacent. Keep the pressure on. Set very lofty goals. Even if you miss them, it will drive the team. And be relentless with your time. Be maniacal towards driving them. Be your chief motivating officer and biggest cheerleader. They're going to continue needing your encouragement and positivity, but you need to work fast. Otherwise, you'll burn your capital very quickly, and you'll need more capital, more emotion, disappointed investors, and against you at this stage. Start getting a little formal, right? Define your mission. Spell out how you understand your market. Who's my target customers? Why is he the target customer? What do they need? What persona am I talking to? How do I win? It'll help you guide your focus and stay focused on the mission and your target market. Make sure it's indoctrination. Everybody in your company understands this and understands where you're aiming at. So everybody is working with you towards your goal. Again, don't allow for distraction and shiny object. One company I was at, unfortunately, it was the same company I mentioned before. We'll keep the name a secret for innocence, but every sale was a new invention, a new presentation, new product options. It was tempting because they were somewhat bigger deals, but we had to stop everything and build something new or modify something, and it just was not scalable. It wasn't replicable at speed, and that was a big mistake. And unfortunately, at the time, the founder wanted to continue doing that. We ended up with a very complex product that solved very complex problem for very particular people and not a simple problem for enough people to make the company scalable. KPIs are keys. You need to know what's working and what's not, and make quick changes. Test and iterate constantly and be agile. Don't stick to one thing and assume it's always going to work. Be very skeptical, always on the lookout for variation in your KPIs that may be telling you something that was working, stopped working, and then change and be agile there. Obviously, everybody talks about holding people accountable. So make sure that you do that. It's nice, but it's important to say how. Have clear KPIs. Have clear responsibilities. Who has the ball? Everybody needs to know who has the ball and what they're responsible for doing. Make your KPIs and assignments public, meaning to your team, and hold group reporting sessions weekly. So everybody has to stand in front of the team and tell them whether they achieved the goal or not. Public accountability is the most powerful tool, because nobody wants to stand in front of their teammate and say, I failed you. I was not able to deliver what I promised to deliver. People work weekends and nights to avoid that pain of publicly being able to being in a situation where they have to report they couldn't do what they promised they would do. So there's a very good system by Patrick Lencioni that you can look at the book, and it talks about trust and accountability in teams. Make sure you protect the culture that made you successful in the first place. Analyze and document it and evangelize it in the company so it's intentional and clear. When you review people, review them with their adherence to that culture. Don't grow out of your entrepreneurial spirit. Don't get tempted to become a very bureaucratic organization. That basically kills your drive. Don't get stuck in processes. Make sure, though, you write down your processes so they're teachable and repeatable and thus scalable. Be aggressive in failing quickly. Learn what works and what doesn't, and focus on what works. Failure is okay, but learn from your lesson. Don't persist in failure. Learn from the lesson, adjust, and move on. And more important, lastly, celebrate short-term successes. You have to establish short-term goals that everybody can feel good about and celebrate, so that you have the energy to keep going and your team has the energy to keep going. Reward sprints, don't reward marathons, okay? And then some shortcuts to execution. Don't build anything that's not core to your mission. Rent, borrow, steal, whatever it is, use Excel. People buy tools and get involved into integrations and other things that are peripheral to their core mission, and they complicate their lives and they waste their people's time. We ran revenue calculations off of Excel for 3 years. Your ATS software can wait. Don't get bogged down with these things. Focus on your success pillars. Don't get distracted. I talked about this. Be very analytical and data-driven, understanding what's working and what's not. Move fast, break some eggs, move again, grab land, grab customers as fast as you can. Build flexibility everywhere. You don't know what you don't know. It's even in client contracts, so you don't get painted into a corner. So if you're not sure how your costs will scale, put a clause in your contract that allows pricing renegotiation if certain conditions change, subject to client approval, of course, but build that so there's an expectation that you can manage it. Leverage fractional teams, borrow teams from whenever you can. Currently, for example, in the compliance and fraud function, we are borrowing a team. We haven't hired our own people because that's 15 people I don't have to pay monthly. I can pay them just for a monthly fee that's very minimal compared to the expertise I'm getting. Your early team members are your most critical one. Choose the correct functions and the right cultural fit because they will define your culture. Build an advisory board. Get people from the industry and from companies that went through what you're going through. Get different specialties that cover each important function of your business. Somebody who's been successful in sales, somebody who's been successful at culture management, investor relations. Use their advice, use their connection. Get 3 to 5 people, meet a month, give them some shares, and they can be an invaluable tool. So lastly, I was going to talk about communication and dealing with board. First recommendation, never miss your first or your first year, because this is credibility for you. So your first few months or first year, ideally, of forecast have to be right on or you exceed them, and build credibility and trust, because after that, a lot of mistake can be forgiven. I'll use Alec Baldwin. If you haven't seen this classic, Glenn Carey, Glenn Ross, always be closing. ABC was their mantra. I would say ABSE, always be setting expectation. Educate your investors constantly on your KPIs and challenges. If your board knows what's happening in the company, they'll be more accepting when things don't work. They'll be more accepting on challenge, and they can be more helpful. And your conditions will evolve, so you need that help. They'll be more supportive when you hit your first wall. And it also gives you control of framing the issue, defining what the goal is, so it's not imposed on you externally. Last thing you want to do is give the driver's seat to the board because they don't feel that they knew what was happening and now they're in freak mode and they're trying to control things. Have an ally. Keep an informal phone line with your key, let's call him handler. Even if you talk about vacation plans or dogs, just stay in touch with them, build this relationship, keep them updated with the business, communicate proactively, because this is going to be your best ally in your VC group. And the more they know, the more they can help you, the more they can also manage their colleagues. So when you have a board meeting, they can be the person that's helping the board understand what's happening and what you're doing about it. But don't completely disconnect from the main person, let's say, the VC firm or the highest ranking officer that you ever had in touch with. Again, ABSE, set their expectation, make your handler look good. So their employee, right? Their employee is there to succeed at their job. So make them look good, give good results, but also praise them on how they're working with you, how helpful they're being, how understanding they are of the business. That is going to empower your handler with their bosses on helping you manage through rough waters. So make that friend, but again, this is not a best friend. This is a person you're managing. It's almost like a spouse. So you don't have to confide everything. For example, doubts and anxieties are a no-no. But market changes, a tough client, an expected loss of a client, that's okay. Prepare them so they don't have any surprises. Nobody likes surprises. So out with the bad news very quickly. Your first call when you have bad news, well, first you have to develop what's your bad news, but very quickly, and you don't wait a day. Hours at most, and you pick up the phone and communicate the bad news and what you're going. That will help you build that credibility that says people are not shoving things under the carpet and hiding things from us as investors, so we can trust what they are saying and we can trust how they're going to resolve problems. Once you have that trust, you'd be amazed how cooperative and forgiving VCs can be. Ask a lot of questions from your investor. They have a lot of experience. Seek help. They've seen these same things you're going through in other companies. Keep your formal meetings simple. Don't go into too much complexity. Don't confuse your investors. Don't be meandering through all the things that go through your mind that are very complex and very complicated. So keep the formal meetings very simple. High-level KPIs, result, challenges. Challenges are important. Be proactive in communicating the difficulties and the bad news so they can expect them and manage them. ABSE. As a CEO or co-founder, what are your 3 areas of focus in the next period? And what are your 3 top challenges? That's what I like to do because that keeps things in focus and helps get the investor mind frame into where they should be helping, but also what issues could come up and what they should expect. Don't try to fill them with too much data because that's typically, I say, if you dazzle them with data and slides. Too much information usually to me becomes an indicator of there's something going on that they don't want me to see, and so they're giving me way too much information and trying to kind of confuse the issue. I don't like the technique. It sometimes works if you need that tool, but use it very sparingly because it'll work once or twice, and after that it'll backfire. Another recommendation: never throw your team under the bus in front of investors. You're accountable and responsible. You pick these people. It's a lesson moment, a growth moment. Don't go, Joe is terrible, he did a very poor job at this. I told him to do X and he did Y, and that's why we failed. It's on you. It's not on anybody else because you hired Joe, you picked him, he's responsible. That means you're responsible. But that doesn't mean you cannot establish a scorecard for your key team members and grade them and develop plans for them. Investors, again, can help you with that. That can be shared with investors and say, okay, look, I hired here. It's a B- player, but I know how to make them become an A player. And as long as you have the visibility, then this is fine. And last but not least, the same way you manage your team, celebrate successes with your board. They're in there with a very risky mission on their end. And yes, they make 10 bets and they hope one succeeds. You want to be the one that succeeds. But you also want to give them that feeling of winning. And so when you have a success, and you remember we've talked about defining the successes short term, have these successes celebrated with your investors. Call your main handler, call your top person at that VC and tell them about the win, tell them, give credit to your team and have a little celebration, even if it's having pizza around the corner, because they need to feel good that they've made the right choice. So this is the end of my quick talk here. I think we're on time, maybe a couple of minutes over. Javi, how are we doing on time?
Yeah, we're gonna have to move on to the next speaker. But before I let you go, Nabil, thank you so much for that. I took so many notes. I really appreciate all that insight. And I wanted to ask you, where can people find you online, whether it's LinkedIn, Twitter, so they can connect with you after the event?
Certainly. So this is my Nabil Kabbani, at Nabil Kabbani is my Twitter handle, first name, last name. You can find me on LinkedIn, obviously. My email is first letter, last name, nkabani@gmail.com. So more than happy to help. If you have questions about this, I can even send you some notes if somebody requires them, but don't hesitate to contact.
Awesome. And, I think we're as we get the other speaker ready, let's take one of the questions from the chat, if you don't mind answering it, Nabil.
So let me see. Yevgenia asked, startups often want to compete with corporate giants and then to buy the same instrument. This can be a disadvantage strategy. Do you think this can be a disadvantage strategy? Do you think startups should take advantage of more technology? That's a great question. I would say, again, keep focused on what is your key to success. Make sure your product is the best. Don't get distracted with a complicated implementation of a sales tool. Yes, you will need it for scale, but find something simple that fits you. You don't want to be spending your CTO's 30% of their time on doing a Salesforce implementation. But there are simpler tools. Salesforce has a tool that's simpler. You're often going to be sold on a very complex type of implementation and be told, well, this is going to accompany you for the next 10 years. Well, I don't want something that's going to work for 10 years because my success is going to be decided in the next 2-3 years. I need something that's going to carry me for my next 2-3 years. And then I can worry about the next phase of large implementation. Don't buy a huge ERP. Don't buy complicated accounting systems. Something that fits you now, that is simple and easy to implement, that's not going to take a lot of time. And we're very lucky at this stage in our startup life is there are wonderful, simple tools, cloud-based, that can be implemented in a few days, up to a week or two at the most, that can do the job. And sometimes you can take a shortcut, and maybe you're not doing 100% of what you wanted to get done with that tool, but the cost of a 1-2 week implementation versus a 6 implementation, or one that never ends, don't underestimate of how much that will drain you in terms of time, focus, and resources. We've used a consultant to do a very complex integration between SalesLoft and HubSpot and Salesforce in our company. 6 months later, we had to fire the consultant and stop that implementation because it became pretty much the biggest project of the company instead of our product being the most important thing. And we were just sinking. So we ripped off everything, stopped everything, wasted $500,000, and had to buy simpler tools and do some manual processes that were enough for the scale at which we were at. So, be skeptical about those big implementations. Good question, Evgenia, because a lot of people can get hurt with implementations like that.